All right, welcome to this explainer, where we're going to put Abbott Laboratories through the absolute ultimate stress test. Today, we're acting as expert investment analysts. We're going to take this healthcare titan and evaluate it using the legendary value investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before dragging it into the modern era with discounted cash flow and alternative valuation models. It is basically the ultimate gauntlet to see if this stock truly deserves a place in your portfolio. Let's dive in.
Here is our roadmap for today. 1. Company snapshot. 2. The Buffett lens. 3. The Lynch lens. 4. The Graham lens. 5. DCF and alternative models. And finally, 6. Synthesis and recommendation.
Moving right into part 1, company snapshot and strategic moves.
So, let's look at the patient on our examination table. At $124.43 a share, Abbott, ticker ABT, is a massive $153 billion diversified healthcare giant. They operate across medical devices, diagnostics, nutrition, and established pharmaceuticals. But, as investors, we don't just buy good companies, right? We have to buy them at good prices. We need to figure out if this current price actually offers us a true margin of safety.
And we really can't look at Abbott today without talking about this massive strategic move. Abbott recently closed a $23 billion acquisition of Exact Sciences. This is a game changer because it brings the highly successful Cologuard screening test along with a massive precision oncology pipeline right into Abbott's fold. It completely shifts their growth narrative, adding an expected $3 billion in incremental sales by 2026. Keep that in mind as we run our numbers.
Part 2, the Warren Buffett lens.
Our first gauntlet is the Warren Buffett lens. The Oracle of Omaha is always looking for economic moats and pristine balance sheets. And honestly, Abbott passes with flying colors here. It boasts a wide economic moat supported by incredibly high switching costs and massive intellectual property. Plus, management runs a seriously tight ship. For every single dollar of reported earnings, Abbott generates $1.47 in operating cash flow. Add in a highly manageable debt-to-equity ratio of just 0.19 and a solid return on equity of 12.5%, and you have incredibly high-quality, cash-backed earnings.
Now this number is crucial. Abbott generated a massive $7.4 billion in free cash flow in fiscal year 25. This perfectly represents Buffett's owner earnings test. It's the actual tangible cash the business throws off that can be taken out without hurting operations, which easily covers their dividend, debt paydown, and share buybacks.
So, what is Buffett's final verdict? Well, he would absolutely classify Abbott as a wonderful company. No doubt about it. However, Buffett is a disciplined value investor. Since our blended fair value models put the stock in the mid-130s to 140s, demanding a strict 15 to 20% margin of safety on that intrinsic value means Buffett will likely wait for a slight dip. He'd probably be looking for a price closer to $115 before pulling the trigger.
Part 3, the Peter Lynch lens. Shifting gears to the Peter Lynch lens, he loved straightforward businesses and categorized them to really understand their potential. Lynch would categorize Abbott as a reliable stalwart, basically a large, steady grower that offers great downside protection. But that Exact Sciences acquisition is fascinating here because it injects brand new, fast-growing recurring revenue. With Cologuard rescreens now making up 25% of all tests and compounding rapidly, Abbott is essentially a stalwart that's trying to rev up its growth engine.
But here is the rub. Lynch is an absolute stickler for the PEG ratio, price to earnings divided by growth. If we take Abbott's forward PE of 22.5 and divide it by their estimated 8% growth rate, we get a PEG ratio of roughly 2.8. Now for Lynch, a PEG of 1.0 means growth and price are perfectly aligned. At 2.8, the stock is already pricing in a whole lot of future success. Look, Abbott has a superb balance sheet with $8.5 billion in cash stacked up against just $9.9 billion in long-term debt. But remember, Lynch preferred stocks that were largely ignored by Wall Street, and Abbott has very high institutional ownership. So ultimately, despite those rock-solid financials, the high PEG ratio means Lynch would likely rate this a hold at current levels. He'd probably just sit on his hands and wait for earnings growth to catch up to the multiple.
Part 4, the Benjamin Graham lens.
Now it's time to strip away all the growth stories and enter the ruthless, quantitative gauntlet of Benjamin Graham, the father of deep value investing. Running Abbott through Graham's defensive investor checklist is highly revealing. It shows unmatched size at over $153 billion, super stable earnings, and a legendary dividend record. But, and this is a big but, it fails his strict liquidity test with a current ratio of just 1.58, and it completely bombs his price-to-book test, trading at a multiple over 4, which is way, way above Graham's strict 1.5 limit. And it gets even rougher when we apply Graham's ultra-conservative intrinsic value formula. We take his baseline 22.5, multiply it by the recent earnings per share of $3.72, multiply that by the book value per share of $29.94, and then take the square root of the whole shebang. The result? A fundamental hard asset value of just $50.05.
So the crucial takeaway here is that for Benjamin Graham, a stock trading at $144 with a fundamental hard asset value of $50 is simply untouchable. He demanded massive margins of safety. Honestly, he would require a price near $33 to even consider buying this. So Graham's verdict? A hard sell or avoid.
Part 5. DCF Valuation.
Okay, leaving the deep value past behind us, we have to acknowledge that modern businesses with vast intellectual property just aren't always valued well by Graham's asset-heavy methods. So it's built a discounted cash flow model based on that extremely impressive $7.4 billion in free cash flow. We'll forecast that out at an 8% growth rate through 2030, heavily fueled by that Exact Sciences acquisition. We'll assume a conservative 2.5% perpetual growth rate, and then we discount it all back today using an 8% weighted average cost of capital, which is essentially what it costs Abbott to fund its business.
Running those numbers, our base case DCF outputs a fair value of $154. And looking at the sensitivity data, even if we increase our discount rate to 9% and drop terminal growth to 2%, the value is $125, which is right at today's price. This heavily suggests that if Abbott hits its expected 8% growth, the current price is actually undervalued.
Part 6. Alternative Models, DDM and Multiples. Before we synthesize everything, let's quickly cross-reference this DCF with two other established valuation models from our source data, just to ensure we aren't missing anything wild. First, the dividend discount model. Using Abbott's current dividend, a 7.27% growth rate, and a 9% required return, we get a fair value of about $146. Second, applying a peer average 20 times PE multiple to trailing earnings gives us $159. So, both of these alternative models completely confirm the DCF. There is absolutely fundamental support for a higher share price.
Part 7. Synthesis and Final Recommendation.
All right, we have successfully run the gauntlet. It is time to synthesize these vastly different frameworks into one final verdict. Graham hates the stock because it lacks hard assets. Lynch urges patience because the growth multiple is stretched. Buffett loves the quality but wants a slight dip to $115 for a true margin of safety. However, modern cash flow, dividend, and multiple models all suggest Abbott is moderately undervalued right now, with a blended fair value sitting very comfortably in the $135 to $145 range.
So what is your ultimate takeaway here? With incredible free cash generation, a rock-solid balance sheet, and a powerful new cancer diagnostics pipeline driving future growth, Abbott is a very high-quality hold for conservative value investors, or a weak buy for those of you trusting the modern cash flow models. But the real question to leave you with today is this: does this newly acquired $23 billion Exact Sciences growth engine fit the specific profile and strategy of your own portfolio? Thank you so much for joining this explainer, and happy investing.